Hello Internet, my name is Ryan Ingram and today we're going to be talking about how to prepare for a housing crash. Now, according to search engine results, a bunch of newspaper articles, everything that you see on the media, there's so much stuff going on that we have not yet been through together as a country. So there's a lot of growing concerns about foreclosures, a potential housing crash, a great recession larger than anything that we've heard from our grandparents or our grandparents. So a lot of people are just trying to get ahead of that and prepare for what to do, what to expect, and how to safeguard or insulate yourself from all the negative consequences. So by the end of this video, you are going to know exactly how to put yourself in the best position so that you are not impacted or minimize the negative consequences that you experience from this. Okay, so the first thing that we need to do is discuss mindset. That is hands down the most important, and you want to make sure that you have control over that so that whenever you read these articles, hear these things on the news, then it has less of an impact on you because you are already expecting it. So, mindset. Now, I've already recorded a very short video about having a recession-proof mindset. If you haven't seen that, I'll put a link in the description. I encourage you to watch it. I think one of the first things to prepare yourself for is this is cyclical. This has happened before. This will happen again. Every so often, you could expect just a great recession or correction to happen, regardless of the industry or how well things are or aren't. The good news is we have a really good history of making it out to the other side. Granted, things might look a little bit different, but that's okay. And one of the rules that I often think about to just help prepare myself for this is the last in, first out rule. So specifically to the housing industry, we have things like VRBO, Airbnb, micro flipping, wholetailing, a bunch of new fads that have happened here in the industry because things have been going so well for so long. We've been able to get creative, figure out more ways to make money quicker, take something that is a normal rental property, turn it into an Airbnb, and 10x the amount of profit you can make off that one property. But nonetheless, since those are the last in to the industry, they're most likely going to be either the first out or at least the most impacted. So oftentimes when you're going through a recession or you're preparing for a recession and you're getting your mindset right, you just want to think last in, first out. It's time for me to get back to the basics. And one of the things that I like to keep in mind is I have a duplex that was built in the 1800s and it has been a cash flowing property for over 100 years. So that is not the last in. So your good old fashioned rentals, the one family per unit model, is probably not going to go anywhere. Now, the second thing that you should do or focus on is increasing your reserves. Now, I am not a fan of having a large amount of money just kind of sitting on the sidelines, not helping in making more money. But when it comes to a recession, it is always good to have more on hand than less. That way, if things get a little bit tight, if you have to pivot, if you have a few tenants that get laid off and are unable to pay, then the impact to you and your personal life is very minimal because you have this protective buffer between you. So generally, most people are familiar with the 3 to 6 months reserves rule. So this completely and still comes down to personal preference. So what I would encourage everybody to do is the things that you hear in the media that are most bothersome to you, whether it's the amount of money the Federal Reserve is printing, the fact that you're not sure if businesses are going to open once the government imposed guidelines are going to end, or if you're not sure if your tenants are going to be employed or have a job to go back to. Whatever it is that really gets under your skin and bothers you, just kind of forecast that out and think of the worst possible scenario. Do you see this lasting 9 months, 12 months, 18 months? How long? So I would generally encourage people to think about 9 to 18 months in advance. And when I say that, I mean increase your cash on hand from 3 to 6 months to 9 to 18 months. This way, you're still going to be able to sleep well at night because the thing that bothers you the most, you are actively planning against that. I'm sure a lot of you are thinking to yourselves, I have no idea how to increase my cash reserves by that dramatically in such a short amount of time. This kind of snuck up on me. I don't really know what to do. Now, unfortunately, I don't have any magic tricks that I could just wave a wand and make your cash reserves 2 or 3x more than they are at the time. However, there are some simple tricks if you do have assets already to increase your cash reserves. And here those are. The first thing that you could do is reposition your assets. And just because the uniqueness of the situation that we're currently in, there are a lot of ways that you could do this, especially if you are already in real estate investing, since rates are extraordinarily low and lenders are still lending against real estate. Then one of the things you could do is, if you own a property outright or you have a lot of equity in that property, then you could approach a bank and get a loan on that property. That way you are refinancing it, you're pulling some cash out of the home, and you're just putting that money on the sidelines. Now, if this is an option to you, I would encourage you to take advantage of this sooner than later, especially if this is a long-term loan around the 20 to 30-year mark. This is going to be a great way to lock in a low interest rate, fixed payments for a long amount of time. So generally, historically speaking, lenders do not necessarily have a good track record of calling these notes at first. The long-term fixed assets are generally there to stay, especially if they're performing. So if you make all of your payments on time, then you have a very low risk of those being called. Another way that you can do this is by selling off your volatile or short-term assets. If you have any gold or silver, then you could sell those off. If you have an Airbnb, vacation rental, or something that is seasonal or more of a luxury style commodity, then I would highly encourage you, if you're worried about this, to figure out how to either turn that into something more basic like a rental property, or sell it off at a higher retail price so that you can capture that cash or equity and then put it on the sidelines for your mental comfort. Now, if you have a few Airbnbs or vacation rentals and they're still performing very well and you're not necessarily worried about a crash, then don't reposition. Do not attempt to pivot. This is specifically to help people in their mindset think appropriately about the long term and make the appropriate preparations so that they minimize the impact that this is going to have on their world if something actually comes to fruition. Now, the third thing that you can do, which is also maybe the lowest hanging fruit, is to take advantage of lines of credits, especially if they're secured. Banks do not mind doing this. If it's your personal home, then you could probably find your local bank, your local credit union, and they'd be more than happy to give you a home equity line of credit. I know at the local credit union that I am with, they offer home equity lines of credit up to 100%. Of course, that depends on your credit. And if you have several rental properties that all have equity in them, then there are several commercial lenders that are more than happy to kind of blanket those together and give you a line of credit on your entire portfolio. Now, beware though, that this is one of the more volatile and not necessarily the most reliable. Having cash on hand that is in your pocket, that is attached to some sort of fixed rate, long-term loan, is the most favorable position to be in. But having a line of credit is good, especially if you want to take advantage of additional opportunities like foreclosures or undervalued properties, undervalued stocks, anything like that. Traditionally, lines of credits are thought of as short term. They're generally, especially if they are commercial, then they're generally an annual type line of credit. They're going to revisit this on an annual basis, and they're going to check to make sure that you're still creditworthy, that you are still earning in the same amount of income. They're going to check your tax returns, and if any of these things change in a manner that they might not like, then they may call that line of credit and it would be due or payable immediately. Similarly, they're also going to reassess the market, and they're going to see if the market or the current environment or whatever they want to look at. I'm not a commercial lender. I don't quite know all the variables that go into them determining this. I think it also has a lot to do with each bank's personal risk tolerance. But for any reason that they see fit, they could call that note or that line of credit. It would be due payable, and that may put you in a worse off position than before you attempted to utilize that line of credit. So definitely be careful on how you utilize that. But if you are very solid in several other areas, then a line of credit is a very good resource to take advantage of opportunities without technically putting in any of your own money. All right, the third thing that you're going to want to do is revisit your finances, both your personal finances and your business finances. Now, on the personal side, you're going to want to think about all of the variables, all of the things that you spend money on a monthly basis, and which of those do you still need Things like Amazon Prime, Netflix, Hulu, rather than maybe having all of them, you could cut down to just one. Gym memberships, have you still been going? Are you under a contract? Can you cancel those? Vacations, should you only take one this year instead of 3 or 4? Maybe you should only drink one weekend per month instead of every night. And maybe now isn't the best time to build that patio or pergola. Anyway, those are just a few examples of things that you could monitor on your personal finances that would allow you to decrease your spending, which would in turn allow you to increase your reserves and make you more stable for the coming or impending recession. Now, on the business finance side of things, there are also several things that you could look at. If you are a real estate investor, then what are the what's the list of capital expenditure items that you were planning on addressing? By all means, you should still take care of the things that are absolutely essential or necessary. But there's a big difference between a roof that has an active hole in it from where a tree fell through it and a roof that leaks when it's a torrential downpour and the wind is blowing in a very specific direction. The hole in the roof would have to immediately be fixed. You don't want to destroy your property, but it might be safe to go ahead and not fix the roof that leaks in a torrential downpour when the wind is blowing in the perfect direction. And you might just have to tell Karen that she can, and that you'll get to it when you can. There's a big difference between not having running water in your house and not being able to run the washer, the sink, and the tub all at the same time. Again, in that scenario, Karen can wait for just a little bit. In that case, Karen can wait until the market corrects. And the fourth thing that you could do to prepare for an impending housing crash or a recession is to tighten up your analytics. I'm not sure how you analyze your properties or investments, but I'm sure that you have a goal or an ideal investment that you're reaching for. And when the market is doing very well, when everybody is employed, when businesses are constantly increasing their numbers, our natural reaction to that as investors is to loosen up on our analytics a little bit. And whether we like to say that we do or not, we make exceptions that don't necessarily fit our analysis of investments or our investment criteria. For my investment property portfolio, I abide pretty strictly on the 2% rule. I'm a huge fan of that loose metric. It allows me to analyze properties very quickly and make decisions without spending several hours in front of a spreadsheet. However, the better the market gets, the more properties that are out there, the more competitive the environment feels, I do loosen up from that. And I've purchased properties as low as 1.5% because I thought at the end of the day, they're great deals. And if I truly have my 30-year goggles on, then this is still going to be a phenomenal asset for my rental portfolio. However, if I'm truly worried about a recession or a housing crash, then I'm not going to advocate that anybody sit on the sidelines and wait to see what happens. I'm definitely opposed to that mindset, but I will say tighten up your analytics, become more disciplined, and do not make any exceptions. So I will not be buying any properties that don't meet that 2% rule. And if I still feel like things are really bad or trending in the negative direction, then I'm actually going to increase that, and I'm not going to buy any properties unless they meet, the 2.2, 2.5, 3, maybe even 4%. That way I'm not sitting on the sidelines. I'm still actively out there looking for properties that meet this criteria. I'm not just trying to figure out what happens here in the next few months. I'm still constantly investing. But nonetheless, I'm reducing the amount of exposure I have by not taking on any new investments that do not meet this more strict criteria. Now, I'm never going to tell anybody that they should sit on the sidelines, regardless of what industry that you're in. In stocks, people talk about dollar cost averaging a lot. If you're not familiar with that, please look into it. It's pretty much, you don't try to call the low of the market or the high of the market. You just consistently put money into the market. Yes, you're going to buy some overpriced, you're going to buy some underpriced, but regardless, at the end of the 30, 40-year period, you're going to see a positive upward trend because the dollar cost averaging. You got burned a few times on stocks. You got really lucky a few times on stocks, but over the long term, it all averages out. I think that concept can be applied regardless of what industry you're in, even in real estate. Yes, it's a very high possibility that we're at the peak of the market and I am overpaying for some of these properties. But at the end of the day, it's also equally as likely that I'm still buying these as cheap as I'll ever have the opportunity to do it. if you factor in the appreciation over the next 10, 20, 30 years. So it's all about perspective, and you can kind of combine these two, mindset and tightening up your analytics, into one main concept. Now, a good friend of mine named John Clark, he was giving me some advice one day when I was going through a personal struggle of mine, and he said, Ryan, never make any decisions from either fear or scarcity. Now, obviously, this is a lot easier said than done, especially when we're talking about a housing crash, a recession, or something that is going to impact your entire community and potentially even your nation, or potentially the entire earth. But at the end of the day, these two things are all up here. If you put on your 30-year goggles, 40-year goggles, however much time you have left, and really project all of these things over the long term, then both of these really just kind of fade away. The consequences of both of these have a huge propensity to all be in our head rather than rooted in any sort of actual reality. So please keep that in mind and safeguard your mentality, safeguard your mindset, and all of your thoughts from all of the negative things that are happening around you. Focus on your numbers. Do all that you can to put yourself in the best position as possible. Go out there and make a ton of money. Recessions are a phenomenal time to appropriately position yourself so that you could take advantage of all of the opportunities that arise from people not doing these things. So things like foreclosures, your typical fire sales from bank-owned properties, pre-foreclosures, people just trying to dump properties because they have been negligent for so long it's finally caught up to them. There's just a multitude of reasons that things are going to be incredibly opportunistic and open up doors for you to make a significant amount of money if you are in the appropriate position. If you want to learn more about taking advantage of foreclosures, then please watch this video about how to find and buy foreclosures in 2020. And after that, please check out the video about how to fund or finance a foreclosure if this is of any interest to you. So comment below 2020 ! If you are looking forward to taking advantage of all of the opportunities that are going to arise from any sort of market interruption, recession, housing crash, whatever it is. And if you have any questions, comments, concerns, please comment those as well. And if you want any sort of clarification about these things that I just said, please let me know. I'd be happy to help in any way that I can. Thanks so much, and I look forward to talking to you guys soon.